Okay, folks. I I think they did some good things to the audio, so you should hear me much better today. Before I get started, a couple of very quick, well, no, one is a comment, the other is a question. How many of you, and consider this an ongoing question, I'm going to ask it of you simply because I want to be aware of whether you've picked a company. How many of you have picked a company to do your corporate finance analysis already? Okay, so we're moving in the right direction. Only thing I'll ask you is if you haven't picked a company, don't wait too long. Part of the reason is this is an ongoing project. As I talk about the board of directors at Disney, I want you to look at your company's board of directors to decide if it is, in fact, a board that will keep an eye on the management. Okay. Second, I should have mentioned this in the last class, but I did not. When you pick a company, there are two groups of companies I want you to avoid. One is avoid money-losing companies. It's not because you can't do corporate financial analysis, but you're going to very quickly run into a dead end. Here's why. If you have a money-losing company that's been losing money for an extended period and ask you how much should it borrow, don't think too long. What's the answer? What should the answer to that question be? Don't borrow. The fact that they have debt might be a problem, but the fact is they shouldn't borrow money. And ask you how much should they pay in dividends? Don't pay dividends. In effect, corporate finance gets very quickly stymied after the first section. So avoid money-losing companies. So I know some of you will override this. In week 12, you're going to come and say, my return on capital looks negative. Of course, it's going to look negative. You're a money-losing company. And there's not a whole lot you can do. So try to avoid money-losing companies. Second, don't do banks. Okay. So don't pick a bank to analyze, not again because corporate finance doesn't matter at banks, but because they're hyper restricted in what they can do. In terms of investing, financing, dividends, you're going to be moving in these guardrails that are so tight, there's not much room for you to run. If you want to do a financial service company, make it PayPal, right? But be careful because with financial service companies, you have to be aware of the regulatory overlays in order to do corporate finance. You can't just you're doing Kellogg's, you can do whatever you want. Nobody regulates conflicts, right? So you want to borrow money, go out and borrow money. You want to pay dividends, but you're doing Citibank, you don't have that leeway. So avoid money-losing companies, avoid banks. And in general, financial service companies, just beware. Somebody did ask me about real estate investment trusts. Is that person in the room? REITs? Okay. So tell me what makes REITs unique and different from it. They're publicly traded, they're a stock price. Tell me what makes REITs unique and different. First is they're created by the special law in the early 70s, where first, on investing, what are REITs required to do? They have to invest only in real estate. A REIT that invests in technology is already off the table. You can't do it. So investing, you're restricted. In terms of dividends, what are they required to do? They have to pay out 90% of their earnings as dividends. You think this is terrible. In return for all of this, what do they get? They get a benefit. Otherwise, you'll always create a real estate corporation. What is it that REITs get as a benefit over real estate corporations? They pay no taxes. And if you pay no taxes, it turns out borrowing money doesn't make sense. So if you want to do a REIT, walk in with open eyes because you're going to see insane amounts of dividends. You're going to see if the REIT makes sense, very little debt at the REIT level. There might be the real estate, the actual properties. And in terms of investing, all you're going to see is real estate. Don't be surprised. Why aren't they going into some growth business? You can't do it. You're restricted. So in general, if you pick a company with significant restrictions around it, it's okay, but recognize that those restrictions are going to come into play when you think about what to do with your company. So let's go back to where I left you with the Disney's horrifically bad, the worst board of directors I've seen, I wouldn't say in my lifetime, but no, in 3 decades. Full of insiders. The CEO is the chairman of the board, and even the outsiders are not that effective. They don't show up. Incidentally, I talked about Sidney Poitier. He headed the compensation committee at Disney, and he was in the top 10 list of directors who didn't show up at meetings. What happens if you have, this is a rubber stamp board. You know what a rubber stamp board is? Whatever the CEO says, the board rubber stamps. If you have a rubber stamp board, think of what's going to happen. You're going to see the company do things, and as a shareholder, say, why would they do that? And with Disney, this played out again and again in the 1990s. One of the reading suggestions I had, not that you have a whole lot of time to read, is this book called Disney Wars. Read it if you can. It's an amazingly fun book to read to show you how at the top of one of the largest companies in the US, you can have a soap opera playing out. And here's how the soap opera played out. In 1986, Disney was in shambles as a company. It was still living on the fumes of Walt Disney, who had died in the late 60s, right? It was a company that couldn't quite figure out what to do with itself. So Disney hired a new CEO. It actually went to Paramount, which at that time was a much more successful company. And it hired Michael Eisner from Paramount. And Eisner did not want to leave Paramount because Paramount was successful, Disney was not. They gave him enough of a pay package. And he said, well, if I'm going to come along, I've got to bring my personal assistant along. You're saying, what's the big deal about a personal assistant? The days before your iPhones, your personal assistant ran your life for you. They told you where you lived, who your wife was, when her birthday was, basically, or your spouse was. And Disney said, okay, you can bring your personal assistant with you. That personal assistant did not want to come to Disney either. So to get him to come, Michael Eisner promised the personal assistant that he would have a division he could head. He could become a head of a division. That personal assistant's name was Jeffrey Katzenberg. He came in, and true to form, Eisner gives him a division that he thinks is going to crash and burn. The Disney animated movie division, which at 1986 really had no life left in it. They produced what, Fox and the Hounds in the early 70s, nothing, no hits. So Jeffrey Katzenberg becomes head of Disney animated movies. And the rest, as they say, is cultural history. The Little Mermaid, Lion King, basically, you hit after hit. And by 1992, Disney Animated accounted for 1/3 of the profits at Disney as a company. In any business class, if you have a division head who's doing a really good job and that division now accounts for 1/3 of the profits, what would you be talking about doing? Giving that person more responsibility, moving them up the ranks. That wasn't Eisner's reaction. He went to the board and said, you got to get rid of this guy. Now, if this were an effective board, what's the question you ask him? This guy is the most successful divisional head you have. Why would you want to get rid of him? And the answer was very simple. He viewed Katzenberg as a threat to the throne. And true to form, the board rolls over and says, okay. There's one problem, though. To get Katzenberg to come to Disney, Eisner gave him, as part of his contract, the rights to 3% of the revenues or earnings on these animated movies that he produced. I wanted to stop and think, if you got 3% of whatever money is made every time the Sea Witch sings, you would never have to work a day in your life, right? Incredibly lucrative contract. So the board, somebody in the board with a brain still left says, but what about this 3% you promised him, And Eisner says, don't pay him. So on what basis? I don't like him. This is not a good legal reason to not pay somebody. So of course, Katzenberg sues. And the case didn't last very long. The judge got Eisner on the stand and said, Mr. Eisner, why are you refusing to pay Mr. Katzenberg? And Eisner says, I don't like him. And the judge says, no, I don't think that's a contractually reason for breaking a contract. You got to pay him $150 million. And Disney paid Katzenberg $150 million to go away. You know what Katzenberg used the $150 million for? He used it as seed money to start DreamWorks. If any of you guys watch the Shrek movies, notice how they get these barbs against the Disney movies. Sleeping Beauty has an addiction problem in the Shrek movies. Snow White hangs out with 7 perverts in a hut. Basically, you say, what's going on here? This is the history playing out. DreamWorks, when it started, had one objective, which is, hey, we're going to get you, Disney. You say, one mistake, why are you jumping down the boat's throat? You'd learn from your mistake, right? But do you know what Disney did next? They went out and hired Michael Ovitz to come into the company as top man. Anybody know what Michael Ovitz did before Disney hired him? He was one of the leading agents in Hollywood for actors, so you put an age, let's face it, agents do something very well, but they don't really run entertainment companies. They negotiate big contracts for the people, and he was very good at that. He came in, and initially Eisner gives him responsibilities, and 2 years later, he goes back to the board, so you got to get rid of this guy too. And to get rid of Ovitz, Disney had to pay out another 150. By now, this is becoming a pattern, right? In fact, I would suggest going to work for Disney, making Eisner really pissed off, getting fired, and getting 150 million. This looks like a good way to get rich. But each time it happened, the Wall Street Journal would run an article and say, why is the board not acting up? And all you had to do is look at who was in the board to see why it wasn't acting up. Now, it wasn't just me that basically decided that Disney was not doing its job. One of the first activist funds, what an activist fund is? Most funds, when they invest, just move on when they don't like the way a company is run. One of the first activist institutional investors in the US was the CalPERS, which is the California Employee Pension Fund. Now, if you work for the state of California, you don't get Social Security. How do I know? My daughter works for the state of California as a teacher. She doesn't get Social Security. So this is terrible. You put your money into a pension fund that is supposedly managed by California state. And instead of Social Security, you will get paid from the fund. So this is a big deal, right? These are, firemen, policemen, people across the state of California. And early on, CalPERS did its job well. They said, we're managing people's livelihoods and their pensions. We've got to do a good job. We can't afford to just sell and move on. They were the largest state pension fund in the country. And they were one of the first funds to say, we're going to stop and ask questions. In fact, one of the very simplistic, very first measures of board efficiency, they asked 3 questions. First is, and this is very basic governance. Are the majority of the directors outside directors? Remember, in the 90s, there was no requirement on inside versus outside. Second, is the chairman of the board independent of the CEO? Which is another way of asking, is it the same person? In which case, you're definitely not independent. And third, are the compensation and audit committees entirely composed of outsiders? One company failed all 3 tests in 1997. That, of course, was Disney. Piling on, Business Week actually ranked companies in terms of worst to very best boards in 1997. So this is the list of the worst boards. Guess who's on top? Disney. Guess who's close behind? AT&T. It's tough to remember a time when AT&T was one of the largest, most dominant companies in the US. Those companies, but in the 80s and the 90s, AT&T had this objective of making themselves smaller and less dominant over time. And they actually made choices based on that. Their board was second on the list. So in 1997, Disney's board was a disaster. So I wanted to look at how much had changed. So I'll come back and talk about what Disney looks like today, but this is what Disney's board looks like today. On a surface level, it looks much better. First, instead of 17 members, it's 12. It's more diverse. And let's face it, diversity in your board can lead to more questioning, maybe. And, Bob Iger sits there, but, he's been a director. He's no longer chair. I don't know whether he is chair of the board, but he was briefly at least not a chair of the board. This looks like a much better board, right? I'm going to argue that this board competes with the 97 board for worst board ever. And I'll tell you why I think that is. And I'm going to emphasize that because since the 1990s, much of the revolution or reforms in corporate governance have been driven by, we've got to make boards more independent and effective, but it's become checkbox corporate governance. You know what checkbox corporate governance is? You look at how corporate governance scores are based. They look at how many directors do you have. Around 11, that's good. So companies have the board of directors around 11. More diversity in the board, good. Check it off. This is performative corporate governance. In other words, we're going to look like we have an effective board, but nothing's changed. This is why fixing corporate governance is so difficult. It's not just check, check, check. You got a more effective board. And I think we need to have a debate at least about how do we create more effective boards. This ain't doing it. So as you look at your company, at first sight, in fact, not only will they have a board that looks much better than the Disney board, they'll have 20 pages on corporate governance principles that they follow. The longer that section, the worse corporate governance is as a company. So let's look at what happens when you do this. And I'm going to take a pause and ask you to take a look at your board of directors and ask some fundamental questions about it. First, just look at the composition of your board. Who's on your board? How many people, insiders, outsiders? Is the brother of the CEO on the board? That's usually a red flag. Okay. Second, look to see whether there are any external measures of corporate governance. Don't trust them further than you can throw them. Okay. Yahoo Finance, if you look under, you find your company, you click on profile, at the very bottom lists out how they rank the board. They actually don't do it. They board institutional shareholder services that does this ranking. It's become a scoring system. So at least get a starting point. But the question you should really be asking is, how effective is my board? Not how does it look, but how effective, and what would give away the effectiveness of the board? Are they pushing back at the CEO? Is there a big decision that the CEO pushed for that the board said don't do it? Boards are supposed to be a check on the top management. They're supposed to slow the top management down when the top management gets into its head that it wants to get something done. That's what you're looking for. It's tough to find. Very few companies have it, but that's an effective board. Question? 6K plus doggone, I guess. The Zoom feed is not. Looks like it's on for me. I'm seeing 24 participants on it, so maybe it's on their side. Thank you for letting me know. So any questions about board effectiveness? So let's talk about what happens when the board has little or no power. So you're the CEO of a company, you have a board of directors that effectively has little power over you, and you know it. You know what you're going to do? And this doesn't make you a bad person. You're going to put your interests over shareholder interests. You're going to treat the company's money as your own. And here are some manifestations. These are things that you see at companies. We look and say, really? Who are you doing that for? Let's start with the first one. It's called greenmail. You know what greenmail is? It's just like blackmail, but it's a lot more money and it's legal. So here's how it works. I'll take you back to the early 1980s when greenmail became most widely used. Now, 1983, oil company in California, Unocal, was targeted by an activist investor called T. Boone Pickens. It's a legendary activist investor. So you're going to be the top management at Union Oil of California. And I'm Boone Pickens. Now remember, if you're an oil company CEO or top management, you've had a decade of doing nothing and your profits went up because oil prices kept going up. So you've had a good, easy decade. So you live in Brentwood, California, great, nice house. You wake up at 11 o'clock in the morning. What are you going to do getting into work early? So the oil price is going to go up anyway. And while you're having your coffee, you read a news story that T. Boone Pickens has targeted Union Oil of California in a hostile acquisition. What's the essence of the word hostile in that hostile acquisition, what does it tell you about the investor's end game here? What is he planning to do? Basically, he's going to fire you. No, forget about structural changes. Who cares about the organization? It's all about you. Your Brentwood house is now at risk. So you jump in your car, you go into work, and top executive meeting has been called. Everybody's in attendance. And there are two things you can do at that meeting. One is you can say, we have to do the right corporate finance thing. This guy's offering $25 more than the current stock price. Our objective is to maximize stockholder wealth. We'll sell the company. That's option one. Option two is you say, you know what? We'll make this guy go away. And they did. They went to Boone Pickens, who spent $100 million to acquire 5% of the company. The reason he had to make a public announcement was because when you get to 5% of the shares, the SEC requires that you reveal your intentions, what you plan to do. Do you just plan to own 5 to 10%? Do you plan to take over the company? And he says, well, I plan to take over the company. They went to Boone Pickens and said, you spent $100 million buying 5%. We'll pay you $200 million to go away. And blackmail, you pay off a blackmailer. The only problem is he or she comes back for more, right? Here, lawyers are involved. They make sure that this doesn't happen by making this particular acquirer sign what's called a standstill agreement, effectively saying, if you take the $200 million, you can't come back tomorrow with another 5% and repeat this process again. At least they were thinking through that. They pay $200 million. Boone Pickens goes away. Now, I've never understood how, as CEO of a company, you can get in front of shareholders of a company and tell them that you did it for them. I'm going to try. Your Unical shareholders. I'm the CEO and say, I did this all for you. I took $200 million of your money. Remember, this wasn't managerial money, shareholder money. And I paid off Boone Pickens to make sure you did not get a stock price 20% higher than the current price. And you can say, you did what? To do what? Let's be clear. The only group that's protected from greenmail by paying greenmail is incumbent managers. Let's at least be honest about it. This has nothing to do with shareholders. So that's greenmail. Second, golden parachutes. So one thing that has always troubled me about M&A is this weird mix of James Bond movies and medieval times. Have you noticed this? There are white knights and golden parachutes and poison pills, and basically things you expect in a spy movie and medieval times. You know what golden parachutes are? This is top management going to their lawyers after they've been targeted, and this is key, after they've been targeted in acquisition, and putting in clauses into their contracts that say, if the acquirer wins, we get paid $20, $25, $30 million apiece. The case of Revlon, collectively, the managers at Revlon put in clauses that cost $500 million. You're saying, why should I care as a shareholder in Revlon? You know why you should care? Because the acquirer will now pay less because he or she has to pay the $500 million to the managers. Again, nothing to debate here. Do golden parachutes help a group? Yes, it's incumbent managers. Nothing to do with shareholders. Poison pills. Poison pills are things you introduce into a company that make it unpalatable to an acquirer. I'll give you a couple of examples. I think until a decade ago, they might have eased this rule. The FCC had a rule that a company could own only one TV station in a city or an area. So if you owned a TV station in New York, you could not buy a second TV station in New York. So let's say you're a company which is being targeted in acquisition. I'm the company trying to acquire. I own a TV station in New York. You know how you stop this acquisition? Right after I target you, you go buy a TV station in New York, then you go to the FCC and you can't allow these guys to take us over. It'll break the law. Perverse, because you're paying more than you should. You're doing it explicitly to stop an acquisition. Here's another example. You know how a rights plan works? It's common in Europe. It's not that common in the US. Somebody want to describe to me what a rights plan allows you to do? You get the right to do something, obviously. What is it that you get the right to do in a typical shareholder's rights plan? you get the right to buy additional shares in the company based on your shareholding at a price well below the market price. So let's say you have a stock that's trading at $10. I give everybody, you're all shareholders in the company, the right to buy an additional share for every share you own at $5 per share. You see, that's terrible. That's discounting the share price. It doesn't matter, right? Because you pay it effectively, the shares afterwards might be worth only $8 or $9, but everybody exercises the right. In fact, it's the most cost-efficient way to raise new equity rather than issuing new shares. We'll talk about why US companies are reluctant to do it. That's a typical rights plan. Here's the poison pill version of that rights plan. The poison pills version, I create a rights plan where stock price at $10, I give you the right to buy an additional share at $100 per share. You say, why would I want that? I'm not going to use it as long as I run the company. But in the event of a hostile acquisition, guess what happens to the rights price? It goes from $100 to $1. Effectively, it's useless as long as I run the company. But the minute somebody tries to acquire the company, it blows up in their faces. If you're struggling with both those examples, I'll give you a third example to illustrate what a poison pill truly looks like. I have 4 kids. They've all grown up now. But I have 3 sons and a daughter. My daughter is third in line to the throne. There is no throne, but if there were a throne, she'd be third in line. So this was when we had only 3 kids. I would take them out for breakfast or brunch the weekend. So I'd take the 2 older boys and my daughter, and we'd go to a diner. They'd sit across, but nobody wanted to sit with Dad. They'd all sit on the cubicle on the other side. My daughter in the middle, her 2 older brothers on either side. They'd all order eggs with fries. The waitress would put the plates in front of them. And the minute the waitress put the plate in front of my daughter, here's what she would do. She would spit all over her fries. Disgusting, right? But if you had siblings, you know exactly what she was doing. Because you're in the middle, you've got 2 older brothers on either side of you, have fries on your plate. You know exactly where the fries are going. They're not going in your mouth. She was introducing a poison pill. You see why spitting on your fries is a poison pill? You spit on your fries, you don't care, it's your own spit. Everybody says, I'm not touching that. It's a very effective strategy that some of you might have used on your siblings to keep them from eating your peanut butter sandwich or your cookie or whatever it is. Just lick the damn thing in open sight because everybody's got to see you do it. The only problem is managers are spitting on fries, but they didn't pay for the fries. Shareholders paid for them. So when you think poison pill, think spitting on your fries, you pretty much got the idea of what companies are doing. Now, if you look at green mail, golden parachutes, and poison pills, you don't need shareholder approval. You basically can get it with the board of directors signing off. And we saw how ineffective boards are. The last 2 need shareholder approval, which raises the question, why would shareholders approve something like this? One is called shark repel. These are anti-takeover clauses that you put into your corporate charter. Let's take a simple one. Typically, what percentage of the shares in a company would you have to take over to get control of a company? What's the typical threshold? 51%, right? In the early 90s, NCR was targeted by AT&T. They went in and changed the clause from 51% to 67%. You think, can they do it? No, it's a corporate charter. What does that do? It makes it more difficult for the company to be acquired. Again, I can sell you a song and dance story about how it's good for your shareholders. They say, look, I'll use it to negotiate a higher price for you as a company. And usually shareholders fall for it. But shark repellents require shareholder approval, and effectively, they put managerial interest over stockholder interest by giving them more power. But the final example to me is the most egregious example of where managerial interest went out. I don't know how many of you plan to go into M&A, but I firmly believe that more value is destroyed by M&A than any other corporate action taken out there. Sounds like an over the top, but if you think about what happens in an acquisition, you're going to very quickly see what a bad acquisition can do to a company. So I'm going to use an example from way back in time. But basically, if you look at the evidence on acquisitions, there's only one group. Actually, let me take it. 2 groups that benefit from acquisitions. One is guaranteed to benefit, which is the bankers, right? The deal makers, right? They make money no matter how bad the deal is because it's based on the deal fees. The other is target company shareholders for a simple reason. To do an acquisition, what do you have to do? Pay 15, 20, 25. No target company shareholders have ever complained about how terrible M&A is. So if you look at just the target side of the acquisition, it always looks good, right? But to see if an acquisition is creating or destroying value, and try this out the next time you see a news story, I want you to also look at the acquiring company's share price. And then look at the collective value added or destroyed by adding the two. On the day Microsoft targeted Activision, Activision's equity value, and of course it was 2 years ago because it then got the legal challenges, went up by 20 billion. You're saying this is great. But Microsoft's equity value went down by 25 billion. Collectively, investors looked at it and say, this deal is going to destroy value. Now, of course, if you ask managers, their response is, shareholders don't see what we can see. We have the information. We know more. The bankers have run the numbers, and this is a good deal. And let me start with a simple question. Do managers know more than shareholders? Yes, absolutely. I concede that. They can see the inside of the company. But managers have a problem that shareholders don't, which is they're biased. If you're the acquirer especially in a friendly merger, of course you're going to say, in fact, if you listen to the acquiring company CEO about whether a deal is good, what percentage, and if you test it out, what percentage of acquisitions should be good deals in terms of creating value for the acquiring company? 100%. And here's where the evidence starts to get really negative. McKinsey, I think, has done these studies over intervals of time where they look back at acquisitions to see what percentage actually create value. If you wait 5 or 10 years, increase earnings, increase growth, all that great stuff. Consistently, they get results of 30 to 35% increase value, 65% don't. KPMG did a study with almost 10,000 acquisitions. And they concluded that in 84% of all acquisitions, there is no synergy created or negative synergy. You know, saying what's negative synergy? Two companies come together and actually become less valuable than they could have been as independent companies. So I'm going to take you back in time to a very old acquisition because it kind of brings all the things that can happen when you do an acquisition, you don't think through it. In 1987, Eastman Kodak was a well-regarded company. In fact, it was part of the Nifty 50 from the early 70s, great growth companies run by great managers, traded at a premium. But by the 80s, its business was slowing down. And Eastman Kodak, like many companies, made the mistake, when your growth is slowing down, what do? You call in a consultant. And they called in, I don't know, must have been BCG with one of their matrices. You've seen these cash cows, dogs, pigs, and all roaming all over. It's like a barnyard of companies. And they said, you got a nice cash cow with your cameras. Remember in 87, Eastman Kodak still had camera and film. You need a star. Star is a high growth business. In the late 80s, the star businesses were pharmaceutical companies. It's a taking off of the pharmaceutical boom. They said, go buy a pharmaceutical company. There'll be synergy. Now, I'm not quite sure how a camera film company gets synergy by buying a drug, but maybe they can deliver the drugs through the camera lens. I don't know. Right? So they go out and bid for this company called Sterling Drugs. Sterling Drugs stock price was trading at $40 when the bidding starts. They were bidding against a Swiss pharmaceutical company called Hoffmann La Roche. At $72, Hoffmann dropped out, but Eastman Kodak did not seem to notice. It's like being on eBay, you're bidding against somebody, the person drops out, you keep bidding against yourself. Eventually, you're going to win. And in this case, they did. And they paid about $90 per share in the acquisition. Wall Street Journal headline the next day, Eastman Kodak wins bidding war. But here's what happened on the day they won the bidding war. Their market cap as a company dropped by $2.2 billion in one day. Now, this might be pure coincidence, but if you looked at the premium they paid on sterling drugs above the $40 stock price, it was roughly 2.1 billion. You know what a zero-sum game is? Basically, there's zero at play. You overpay. Guess where that money has to come out of? It has to come out of your shareholders' pockets. You're saying, what about the extra 100 million? Hey, the bankers still have to get paid. This was a horrifically bad deal. And at the time of the deal, Eastman Kodak said, trust us. We know what we're doing. So let's say you trusted me. You had no choice, right? As Eastman shareholders, you basically went along with the deal. The board agreed to it. This is what the numbers look like for sterling drugs in the 5 years after the deal. And these were 5 years where pharmaceutical companies were booming in terms of growth. I dare you to find any synergy showing up in the numbers there. It looks like they're basically stuck in neutral. The deal wasn't working out. 80% of deals, this is the problem. As you track those deals long enough, you can't find the growth, you can't find the earnings, you can't find the synergy that was talked about at the time of the deal. Now, to complete the picture, eventually, rumors started to float around that Eastman Kodak was thinking of selling off sterling drugs. I mean, again, they brought in probably another consultant to say, you got to divest yourself as a bad performing business. Maybe the same consultant who told them to buy the business. There's no shame involved in this process. So when the rumors first started, Eastman Kodak denied it. No, we're not selling it. In fact, the chairman of Sterling Winthrop, the division of Eastman Kodak that was the drug business, said, massive speculation which flies in the face of the stated intent Kodak that it's committed to the health business. Remember the old saying, never believe anything until it's officially denied? Turned out you guys were lying. In fact, a few months later, they sell off, sell off sterling drugs for about 1.7 billion. And nobody remember what they paid. They paid a total of 5.1 billion. Let me ask you a question. If you pay 5.1 billion in 88 and get back 1.7 billion in 1992, what kind of internal rate of return do you think you don't even need to calculate? This is a horrifically bad deal. But here's the damage that went beyond the deal. Remember the reputation Eastman Kodak had in 87? Well-run company. I know this might be overreaching, but I think Eastman Kodak's fall from grace can be traced back to that one day and that one deal, because nobody ever trusted them again. You can take a look at what's left of Eastman Kodak now. It's a carcass of a company. There's a name, but the only reason people want the name is maybe they can use it on something else. You can take a great company and devastate the credibility of the company with one big deal. Okay. Yes?
How much do you think that that deal is a product of either the actually acquiring company?
Very seldom is it miscalculation. And I'll tell you what, it's not even incentives that are explicit. If you've ever been in a company when people start talking about a deal, and usually the people talking about the deal are not the people in the middle management or the people at the top, the deal takes on a life of its own, right? It becomes very difficult to stop it because how do you define winning? You heard of the winner's curse in auctions? You know how you win an auction? You pay more than what everybody else in the room thinks you should be paying. That's the way you win an auction. The deal takes on a life. Winning the deal becomes getting the deal done. When in fact, a winning deal should be getting a good deal done, but the good gets dropped out, the deal gets done. And let's face it, you got an ecosystem egging you on, right? I mean, we can talk about the incentives of the bankers involved, but again, it's really, I think, management ego effectively driving the deal, because losing the deal is viewed as, lost this battle. And if you get locked in a bidding, first rule in a bidding war is drop out. But people never take that to heart because they want to win. I think it's defining what winning a deal is. And let's face it, the popular press goes along, right? Wall Street Journal headline, Eastman Kodak wins bidding war. Nobody stops and asks the question, is this worth what you paid for it? So I think sometimes you just can miscalculate, but often you look at the overriding factors, It's got very little to do with getting the numbers right. It's got everything to do with other incentives coming into play. It's other people's money. Let's face it, right? You're the CEO of an acquiring company. You're playing with other people's money. So what I'd like you to do is take your company, and I'd like you to think about where the power lies in the company. I mean, remember the old saying, power abhors a vacuum? Somebody's got the power, right? If you're shareholders and you don't have the power, the question you got to ask is who has the power? Because sometimes, at least in corporate finance, you can talk about outside shareholders effectively running the company, which is the utopian word. But there are some companies where inside shareholders run the company. You're Tesla shareholders. I'm a Tesla shareholder since last week. I have no illusions about running the company. I know who runs the company, and I know zero influence in what he does. It's Elon Musk's company. I'm along for the ride. Okay. And so in some companies, it's inside shareholders, either because they own a big slice of the company. Does anybody know what percentage of Tesla Elon Musk owns? You want to guess? It's 13%. So basically, it's not 51%, it's not 49%, it's 13%. Larry Ellison owns 25% of Oracle. Mark Zuckerberg owns 14% of Facebook, but he's cooked the books. He has 57% of the voting rights. We'll come back and talk about why. This is another way in which corporate governance gets skewed, is we create classes, shares of stock, which have different voting rights. So in some companies, it's inside shareholders who run the company. As outsiders, you have no power. In some companies, lenders may run the company. Why? Because you broke a covenant, the bank stepped in, and it's never left. It put directors on the board. You now have veto power. I want you to think through what happens when companies are run by lenders. Some companies' managers effectively are the power center because nobody has an incentive to challenge them. There are companies where the government can be the power, and I'll show you an example to show you how this plays out. It might either be because the government owns a big chunk of the company, or again, because it's fixed the game to be able to control the company without owning that chunk. And finally, there are a few companies where employees have enough shares in the company. In some parts of Europe, actually, employees have directors on the board, and if they own enough shares, they could run the company. So keep the door open, because what you're trying to ask is, which of these groups has the power in my company? So let's take a look at one of the instruments you can use to get that. This is a page that lists the top 17 shareholders in a company. I think right now, I'll send you this comes off a Bloomberg terminal. You can also get it from Yahoo Finance. It's public information. And you can get it for pretty much any company around the world. In some companies, it's more reliable than others. So these are the top 17 shareholders of the company. Here's what I want you to do as I show you each of these pages. I want you to put yourself in the shoes of a shareholder in this company, looking at this company at the point in time that I had this page, and asking yourself, how much power would I as a shareholder have in this company? This is Disney, circa 2003. Take a look at the top 17 shareholders. You're saying, I don't even recognize any of these names. Even if you don't recognize the names, go to the third column and look at the source. You're saying, what is that? The way Bloomberg puts these pages together, and this is how the public information gets created, it was when institutional investors file a document called the 13F, which lists out the shares that they own in the company. When you see 13F there, you already know that that investor is an institutional investor. And if I'm a shareholder at Disney in 2003, when I see this list, my stomach drops, because I know nobody on this list. We'll talk about Roy Disney later, the one name on the list. The remaining 16 institutions are not going to fight the fight for me. Why? Because most institutional investors, when push comes to shove, are going to sell and move on. They're going to vote with their feet. You'd be surprised at how many large publicly traded companies. You look at that list for yourself. You look at Kellogg's, you look at General Mills. The older the company, the more likely it is that you're going to see this, where you have small shareholders or small institutional investors basically dominating the list. There are a couple of institutional names, and I'll give you the suggestions on what you should be looking for, where your spirits might pick up. But this is a managerial company, a company basically driven by managers. Here's my second company. Told you about Vale, the Brazilian iron ore mining company. A little bit of history here. Vale used to be an entirely government-owned company 2 or 3 decades ago. It got privatized. It's now a publicly traded company, but the government lurks in the background. Why? Because there is 2 classes of shares, and Vale was not unique. In fact, until a few years ago in Brazil, every Brazilian company had 2 classes of shares. I'll tell you what they were named, and then I'm going to ask you which class you probably will end up buying if you called your broker and say, I want those shares. The first group are called common shares, and the second are called preferred shares. You see, I'll take the preferred, that looks better. You know why the preferred shares are called preferred? Because you get no voting rights. Now wrap your head around that Orwellian naming of the shares. You get a dividend a little bit earlier than everybody else. Common shares and preferred shares. So when you look at the trading in Vale, it's happening almost entirely in the preferred shares, the non-voting shares. But the company is run by the people who own the common shares. One of the largest investors in those common shares is a fund called BNDES, which is a Brazilian national. So basically, it's run from the Ministry of Finance in Brasilia. But here's where the game is even more skewed. The Brazilian government retains what's called a golden share. What's a golden share? It gives them veto rights over big decisions. So if Vale decides to do an acquisition, the Brazilian government can say yes or no, and its decision is final. The board of directors at Vale are entirely picked by the common shareholders, and I'll wager every name on that list has to be checked off by whoever the Minister of Finance is in Brasilia. So if you're the CEO of Vale, there's only one person you got to keep happy, right? Doesn't matter if your share price is down 30%. It doesn't matter what the world thinks about you. That person is the Minister of Finance, which means your decisions are going to be skewed towards what does he or she want me to do? I'll send you a link to a post I did about 10 years ago now on Petrobras. Very similar structure, Brazil's largest oil company. And this was right after they'd taken a $200 billion company and made it a $30 billion company. And I took every aspect of corporate finance, and my conclusion was, if you are creating a perverse example for corporate finance, where a company did the exact opposite of every principle, you know what that means, right? Invest in projects only if they earn a return lower than the hurdle rate, not higher. Choose a financing mix that completely screws up your cost of capital. And pay out dividends, even if you can't afford them. Petrobras did it. In first reactions, why would they do it? Because at that time, the Ministry of Finance had sent out a mission statement saying, make Petrobras the largest oil company in the world. Not in terms of market cap, but in terms of barrels of oil produced. And you as the CEO took it to heart. You did exactly what the Minister of Finance wanted. You tell me who you answer to, I can very quickly tell why you're acting the way you do. So in case of Vale as a shareholder, you're a preferred shareholder, you might as well just throw in the towel now. You'll have zero role in how the company's run because you have zero voting power. You're saying those terrible Brazilians. In 2004, you could have pointed to Brazil and said, that's terrible, because in 2004, the US had developed a system where almost, there were no, I think other than Ford, which was grandfathered in, companies did not have 2 classes of shares. Because, it was viewed as unfair. And the stock exchanges enforced it. The New York Stock Exchange in particular said you can't be listed in the New York Stock Exchange if you don't have 2 classes of shares. And because everybody in the last century aspired to be in the New York Stock Exchange, eventually, they all followed the rules. Then along came Google. And Google, when it went public in 2004, explicitly created 2 classes of shares. Class A shares had 10 times the voting rights of Class B. And I remember thinking, oh, institutional investors are not going to go along with this. This is so unfair. They'll probably fight back. You know what institutional investors did? They basically lay down and said, oh, that's fine. And the NASDAQ, because it wanted to attract companies from the New York Stock Exchange, actually said, you don't need to, you can have different class of voting rights. That door that Google opened, every big tech company, there are a couple of exceptions, walked through post 2004. I've got to give Tesla credit, at least in hindsight. Musk is probably saying, I wish I had created two classes of shares, but Tesla has only one class of shares. But look at almost every other big tech company, two classes of shares, including Facebook. If you have a company with two classes of shares, you're already doomed in terms of your rights as a shareholder. So I remember talking to somebody after the Facebook, IPO. So why do you guys keep lying down and taking this, accepting shares with lower voting rights? And this was from somebody, a portfolio manager, bought a very big chunk of Facebook. He said, but Mark Zuckerberg is a good manager. Doesn't matter if we have to say he's a great manager. And I had to talk about, I had to tell him about malignant and benign dictators. Many dictators start off as benign dictators. There are almost none that end up as benign. Because as they stay on, they acquire more power. And the problem is Facebook in 2012 looked benign. But those same portfolio managers were complaining to me in 2018 about how Mark Zuckerberg was not listening to them. This is after the Cambridge Analytica scandal. They said, you know what? And they said, buying shares in Facebook and complaining that Mark Zuckerberg is not listening to you is like getting married to a Kardashian and then complaining that a camera is following you all over the place. What did you think you would get? You buy shares in companies with two classes of voting rights. You are going to not be listened to because you don't have any power. Yeah. That's the story the CEOs, the founders tell you, right? We're long-term, you're short-term, and you got to give us more power. That's what dictators said too, right? These elections you have every 5 years, that's a kind of thing. I have 30-year plans for the country. These 5-year elections get in the way. And the next thing you know, it's dictator for life. So I think that you can sell us in whatever you want, but the basic idea of owning shares in a company is you're part owner of the company. And then you're telling me you're part owner, but you don't have any say because I don't like what you say. It just strikes me as unfair. Doesn't mean I own Facebook shares, but I own them with open. So again, it doesn't mean I won't buy the shares. It also means that change is out of the question. I will not buy Facebook expecting change. I will buy Facebook expecting what I get. Right? Let's take Tata Motors. So I took a look at the top 18 shareholders, and I noticed something very interesting. I noticed a lot of Tata companies on the list. This is something you're going to notice with family group companies, a lot of cross holdings. And it's not a conspiracy, it reflects a history. For those of you who don't have any sense of the Tata Group, they've been around 150 years. And for the bulk of their existence, they were entirely a privately owned group. Every company is fully owned. So 1975, if Tata Steel wanted to build a new plant, and Tata Motors had a good year, you know what the family did? They owned 100% of both companies. They would take the earnings out of Tata Motors, put it in Tata Steel, and have an accounting transaction that gave Tata Motors a piece of Tata Steel. You see where this is going. The older a company, the more cross-holdings you're going to get. But it creates a corporate governance nightmare for shareholders. Because when you buy shares in a Tata company, you buy shares in that company. What do you expect the manager of the company to do? To do what's best for you. But if you look at that shareholding, they clearly have bigger interests for the group. Now, when I first wrote this in 2013, this edition of the book, Tata Motors in 2013, and I presented this to a group of Indian investors, they said, but this is the Tata Group. They're an enlightened group. They're not the kind of family that would take advantage of this. Shades of Mark Zuckerberg, right? Benign dictatorships. For those of you who track the Tata, the corporate governance at Tata, you see that even in a group where you think that the family is benign, these things blow up. In fact, in, I think, 2017, 2018, the Cyrus Mistry, who was the non-family, I won't even say non-family group, but he's another family that owned a large chunk. He was brought up through the Tata family to run the company. Eventually got pushed out because he raised a fundamental question. He said, whose interests should be served when with the CEO of a Tata company? Should it be the interest of your shareholders, or should it be the interest of the group? Got pushed out. Effectively, I'm saying no matter how noble you think a family is, giving them this power is essentially exposing you. Right? And to show you how much a family can take advantage of you, if you look at the Tata family, they own about 100 companies. And about 80% of those companies, there are about 80% of those companies, they own 100% of the company. They're privately owned. They're, of course, public companies. Do you see how if I were an unscrupulous family, I can take advantage of you? Give me some ways. Let's think perversely. You're in control of a family group. You want to enrich yourself at the expense of shareholders. Tell me some of the ways in which you might be able to do it without breaking the law. Breaking the law, you can do whatever you want, but without breaking the law. You heard of intra-company transactions? Where one company sells another company. Who sets the prices? The companies do, right? So let's say I have a transaction where Tata Motors is buying something from one of the 100% Tata-owned companies. I could set the price a little higher, not obscenely higher, just high enough that I can get away with it. I'm effectively transferring wealth from Tata Motors to a privately owned company. So if you pick a family group company, check out, I mean, think about the worst case scenarios. They might not unfold, but at least be aware of them. Which brings me to Baidu. Yeah. When you say everything is arm's length, what is arm's length? Whose arm is in there? Who's measuring the length? I mean, because this is a legal thing, arm's length transaction, but let's face it. There's a contract being drawn up. There's no arms being measured length. So the arm's length is a purely legal contrivance. That's why I said you can't take something that you'd pay $10 for and put it at 100. But if you put it at 12 or 13 or 14, I probably can't push back because you could argue that that product is better. That's why we bought it. So, yeah. Yeah. Yeah.
I think arm's length is a legal concept and there is room there.
Oh, there's a lot of room in business transactions.
That is fundamentally okay, or you still think that
well, it might be okay most of the time. See, this is the problem. When times are good, they probably don't feel the urge. But when you get stretched, that's when you're going to see these systems start. And that's always the test of a system, not how well it does in the good times, but how it does in the bad times. Right? Fundamentally, eventually, it's not a question of whether, it's a question of when it's going to break. So don't give them the power to do it because eventually you're asking for trouble. Which brings me to Baidu. And whoever devised this abomination of a system should really be held to account. Now, it's not just Baidu, it's Alibaba, it's Tencent. When you buy shares in a company, what do you think you're getting? You're getting a part ownership of the company, right? So Baidu is a search engine in China, big growth. You're saying this is a good business. They make money in advertising. You buy shares in Baidu. I have some bad news. The Baidu that was listed on the NASDAQ, and Baidu and Alibaba were listed on the NASDAQ for whatever reason, is not the Baidu that has a search engine in China. Say, what's this Baidu? It's actually a company, a shell company in the Cayman Islands that you bought shares in, that has an operating agreement with the Chinese operating company that is technically illegal. And those are not my words. Take a look at the Alibaba prospectus because Alibaba is devised the same way. And in the prospectus, it says the Chinese government can deem this entire arrangement to be illegal. And if that happens, you know what you'll end up owning? This shingle in Cayman Islands. I actually looked up the address for Baidu. It's a P.O. box. It's not even an office. It's a P.O. box. So maybe you can go empty out that P.O. box. There'll probably be nothing there. You bought shares in a shell company. But it gets worse. Who runs Baidu? It basically turns out that you have no power. It's basically the owner, the founder, CEO, the company, who comes up with a list of people who run the company. This is not a traditional company you've invested in. But again, what is the excuse people gave for buying Baidu and Alibaba? It's a high growth economy. I'm getting 1 billion people as my customer base. It's amazing how people are willing to kind of overlook the fact that they have no power by the fact that it's a big market out there. And I'm going to close off with Disney and start with Disney. 2003, remember 16 of the top 17 shareholders at Disney were institutional investors. 2009, I took a look at the top 17, and there's been a change, a big change. Who's on top of the list? A guy called Steve Jobs. You know how he became the largest shareholder in Disney? Is when he sold Pixar to Disney, Disney paid with shares. The minute he sold Pixar to Disney, Steve Jobs became the largest shareholder in Disney. Remember, you're not Steve Jobs, but you're a shareholder in the company. In 2003, you looked at that and said, I have no power. Nobody's going to push back. Do you feel a little better now? I did. And here's why. Why? I mean, people, I think misunderstand what corporate governance is. You want somebody in the board of directors who will push back against the managers, ask them questions. Somebody's not a go along and get along kind of person. And I don't think anybody ever described Steve Jobs a go along, get along kind. I mean, I've never been in a meeting where Steve Jobs isn't there, but I would guess that a meeting where Steve Jobs is on the board of Disney, and he was on the board of Disney, where the CEO gets up and comes up with this cockamamie idea of something to do, that he's just not going to sit back and say, that's, I can't ask a question. I'm intimidated. It's an authority figure. He's probably said, that's the stupidest idea I've ever heard. This is good because that's what you want in the board of directors, is somebody pushing back. Sometimes changes can happen and you look at it and say, you know what, that's good for me. I am piggybacking on Steve Jobs asking the question. That's all we can do. When Bill Ackman buys shares in the company, he's not thinking about you and I when he goes in there. He's thinking selfishly, but we're going along for the ride saying, I don't have the power to ask questions, but that person does. So take a look at your HDS page, and I'll give you a way you can look it up in Yahoo Finance, and I'll tell you where the Bloomberg terminals are if you've never used them. Because there are a few pages, you don't need much from Bloomberg, where it's nice to get the Bloomberg pages. So that's the first linkage. So let's summarize. Stockholders have little power over managers. What do managers do? They put their interests over stockholder interests. Let's talk about lenders. In theory, what happens? You lend money to a firm, you don't protect yourself because this firm is a reputable firm, and you think nothing bad will happen to you. I can safely predict, and this is just like corporate governance. It's not a question of whether, it's a question of when you're going to get ripped off. You think, doesn't it matter what the company is? Let's look at why there's a potential drift between lenders and shareholders. So you guys are going to play the role of a bank. We're going to be equity investors. We're going to come try to borrow money from you. Okay? So when we try to come and borrow money from you and we describe the projects we're going to take with the money, do we describe them as safe projects or risky projects? Is it the safest project ever? We promise you we will take care of the money as if it's our own. So let's say you're a trusting banker, which is an oxymoron, and you lend us the money. Now we have the money. Our incentives are completely different, right? Because there are no strings attached. And here are three things you can do. And I want to think again in terms of perverse outcomes because they can play out. Nothing stops me from paying myself a dividend from the money I borrowed. Companies have done it. Second, if I take projects, I told you I was going to take safe projects, but didn't put it down on paper. There's no legal restraint. I'm going to take all the money and put it in number 34 in the next race that I go to at the tracks. If it pays off, I get a huge upside. If it doesn't, limited liability. There's not much you can do to me. And third, if you don't stop me, I'm going to keep borrowing more and more money on top of the same assets that you thought you were lending on. We're going to come back and talk about these because these are classic conflicts of interest. And this is why you don't have trusting bankers. So as a banker, what do? You write in covenants. You can't do this, you can't do this, you can't do this. But if you didn't write the covenants, this is exactly how it will play out. So let's look at what happens when you lend money to what you think is a reputable company, you don't protect yourself. So let's say it's the 1980s. You're in your mid-60s. You've retired and you move to Florida. You live on a golf course. You got $500,000 in savings you've accumulated. This is supposed to be your savings for the rest of your life. I'm your broker. You come to me and you say, look, I have $500,000. This is my pension fund money. I'd like to invest it somewhere. I suggest investing in an index fund, the stocks. And you said, too risky for me. This is my pension money. I suggest treasury bonds. And you look at the rates and that looks too low. I need the money to pay my golf dues. So I suggest a corporate bond. Initially, you're reluctant because, you know, companies can get into trouble. And they said, no, don't worry. It's a company you've heard of. It's called RJR Nabiscoed. In the 1980s, this was a name you saw in every grocery store, right? All those products that had been around 70 years. And then to soothe your fears, I tell you, look, it's been rated. You have no idea what I'm talking about. I said, it's been rated by S&P and Moody's. You still have no idea what I'm talking about. So it's been given a AA rating. You still have absolutely no idea what I'm talking about. And then I tell you, no AA rated company has ever defaulted while it was rated AA. I'm a very careful broker. That is technically true. That no AA rated company has been rated. So you put your $500,000 into Nabisco bonds and you go back to playing golf. A couple of years later, you wake up to a news story. Read the Wall Street Journal. It says, KKR buys RJR in LBO. You say, what are all these acronyms floating around here? KKR had done a leverage buyout of Nabisco. Remember, you own bonds in Nabisco. What happens in a leverage buyout? You borrow a ton of money. In this case, they quadruple the debt that Nabisco had and buy out the equity in the company and make it a private company. So I call you up. I'm as a broker, you call me and say, what the heck happened here? He said, nothing. Don't worry. You still have the bonds. You still are promised the same coupon. But remember that AA that I told you the rating was, you're still in the alphabet, but you've slid. You're now BB rated. What does that mean? Effectively, the chance that you will not be paid went up. How does it manifest itself? On the day of the LBO, when equity investors were celebrating, RJR Nabisco bonds lost 20% of their value. 20% of the value. Your $500,000 is now $400,000 because you trusted Nabisco to do the right thing. We'll talk about the changes that happened in the bond market after the RJR Nabisco, because in the mid-80s, if you bought a corporate bond, the assumption was, hey, companies have this reputation effect. They will not do something like this. I'm going to introduce a word into the corporate finance language here. It's called Nabiscoed, which is the word you should use anytime you lend to a reputable person or company on the assumption that reputation is going, you're asking to be Nabiscoed. And don't put yourself in that place. So second linkage starts to break down. The assumption that lenders lend money, they don't get protected, they get ripped off. Which brings me to third linkage. What did we assume? That if you're managers in a firm, you go out and you tell the world what's happening to you, honestly and on time. So that 23andMe CEO probably ran out the minute they found out, you've heard the 23andMe, that DNA information got leaked and everybody could see, who your ancestors were. I don't know why that's an issue, but for some people, obviously it was. Something like that happens, you go out and tell the world it's happening here. And markets are rational and cool. In truth, neither of those assumptions holds up. Let's start with the first one. First, managers control or try to control, not always succeed, try to control how information hits markets. We'll talk about how that plays out in practice. And I think that's really an issue that they try to time. There are some companies that step over the line, that commit outright fraud. You've seen the examples play out. I'll give you one of my favorite examples, a company called Bre-X, a Canadian gold mining company. Okay. One of the highest touted gold mining stocks in the 1990s. Based on what they claimed was the biggest discovery of gold somewhere in Indonesia. Now, if you're a gold mining analyst in New York, you've never actually seen a gold mine. Let's face it, right? You've seen gold, you think it comes in bars and coins. So you know how they convince analysts that this was the biggest gold discovery? They flew the analysts out to Indonesia. They salted the sand with gold dust. I'm not kidding. And they told the analyst, look, there's so much gold under the ground, it's coming out. And if you've never seen a mine, he said, that sounds good. They go back, buy recommendation, buy. Until one day, I think in 95 and 96, news story comes out that the head geologists who work at the company had jumped out of an aircraft at 33,000 feet without a parachute, with nothing good happens to you. And then people started asking, so why would he do that? And the months after, the company starts releasing them. We told you there were 100,000 ounces, it's really 10,000, we take out the last zero, then it's 1,000, and soon they said there's no gold. The whole company had been premised on a fraud. Sometimes that does happen. Oh, here's one of my favorite examples, a company called Mercury Finance. It used to lend to people with bad credit histories in the late 90s. Wall Street Journal story shows up. Mercury Finance cannot find their CFO. We've looked everywhere, under his desk, in his house, he's not there. Okay. And last paragraph says half our cash balance is missing. Somebody's having a lot of fun somewhere, but it's not you. An Israeli company called Converse went one step further. We can't find our CEO. It took them 6 months. He was on a beach in Sri Lanka. This is never good for a company, but clearly something fraudulent is going on. But most of the time, when you look at what companies do, it's because they're human. At least the managers are human. How many of you are married? Okay. Let's say something bad happens during the course of the day. I'm not predicting anything, so I'm not contaminating your day. At the end of the day, at least for me, I'm not going to go back home and say, "Hon, I have something bad to tell you." If you have something bad to reveal, you do one of two things. One is you try to bundle it with something good, right? I wrap the car around a tree, but I switched to Geico. Completely disproportional. Or I try to find a good time to reveal the bad news. Usually it's when your spouse is sleeping. You whisper the bad news. And then she, or he or she says, you never told. No, I told you, I definitely did. Companies do the same thing, right? One is they try to bundle bad news with good news. Remember in 2009, every bank that released earnings said, we lost $2 billion, but we're not Lehman. We're not bankrupt yet. That was the good news, right? In case you're wondering. The other is they tried to reveal the bad news when you have the equivalent of the market sleeping. I'll give you an example. Until about 20 years ago, I used to do academic research until I discovered nobody reads academic research, and I decided it was a waste of my time. But this was early in my life when I still thought academic research was read and acted on. So to show you the kind of outlandishly stupid questions you end up asking as an academic researcher, here's what I did. I looked at earnings and dividends announcements by day of the week. Monday, Tuesday, Wednesday, Thursday, Friday. And I looked to see what news they contained in terms of how the market reacted to that. Monday through Thursday, it looked pretty much the same. Relatively good news on earnings, relatively good news on dividends, stock price up. And then you get to Fridays, terrible things happen to companies on Fridays. It wasn't all day Friday, it seemed to happen at a particular point in time. If you don't believe me, watch the news wires at 4:01, 4:02, 4:03, 4:04 on Friday. Horrifically bad things happen to companies. Either that or managers decide that they're going to release the news after close of trading on Friday, hoping what will happen? That whale trade that cost you $7 billion if you're JP Morgan, that was released at 4:05 on a Friday, that you'd forget about it by Monday morning. Fat chance of that happening, which makes Mondays the worst day of the week to invest in. For the last century, if you look across weekdays, Monday, maybe this is because people release bad news after close of trading on Friday. So managers are not that good about getting news out because they try to manage the flow. And markets are not angelic either. Remember that argument of rational, cool markets? No, I think in finance, we've made a mistake of overplaying that. In economics in general, rational investors. And whenever I run into somebody who's caught up in the rational investor argument, I apply what I call the Elvis Presley test. Let me try the first part of the test on you. How many of you think Elvis is still alive? He'd be like 97 years old, I think. No, no, that's good. You passed the first part, so you can relax. The second part of the test actually comes out. You know how most of you have read USA Today, right? I call it my McDonald's version of a newspaper. It's like fast news. You can read the whole paper in 5 minutes if you want. And I don't know whether this is still true, but USA Today used to run a poll every day. Remember, this is a paper that gets published every weekday, so it's 250 days of the year. They run a poll. How many questions can you come up with? So they'd come up with questions like, do you like lettuce on your burger? 72% of Americans said yes, 21% said no, and 7% said, I don't know. Have you ever wondered about this? Any poll, there's a rolling 7% that seem to say, I don't know. Americans were asked, do you know your name? 93% said yes, 7% said, I don't know. Incredibly paranoid group saying, don't ask me any questions. I can't answer them. So this is on the 15th anniversary of Elvis's death. This is 1992 and 93. USA Today runs a poll. Do you think Elvis Presley is still alive? 72% said no. Thank God for small blessings. 21% said yes, 15 years after his death. I mean, if you extrapolate that to the population of the US, that's 66 million people walking around thinking Elvis is still alive. And what do we assume happens when companies reveal news? That people take the news, look at the effect on earnings and cash flows of the next 10 years, discount it back at the 66 million people walking around thinking Elvis is still alive. And you think this is happening in the background? I mean, let's put it this way. There are a lot of people out there who are not just irrational, but crazy. We just have to hope the craziness averages out. But sometimes it doesn't. I've not done a cross check of this, but maybe if you took a list of everybody who owns Bitcoin and everybody who believes Elvis is still alive, maybe you'll get a big interleaving of the two groups. The point I'm making is when we talk about doing the right thing in finance, and I tell bankers this because they go into companies, if you do this, your stock price will go up 7%. They never say that. You say the value will go up 7%. Maybe the price will go up 17% if you're lucky. Maybe it'll go down 5%. The market price is going to be affected by things that are out of your control. In fact, if you look at the critiques of market efficiency, one is that investors are irrational, and that's absolutely true. Efficient market people assume irrationality averages out, but we know there's crowd behavior. But more specifically, if you look at the people examining market efficiency, there is evidence that markets overreact to news. There's also evidence that they sometimes underreact to news, right? There's also, of course, in some markets, a notion that insiders set prices, not just in emerging markets, but there are people in the US, go on social media. All those meme stock people believe absolutely that insiders set prices, that hedge funds and investment banks are in cahoots to set the prices. It's an insider conspiracy. And third, and this is, I think, what I want to talk about, is markets are short-term. And that's a short-term argument, and managers are long-term. So I want to get your priors, because I think that is a legitimate place to go. So the question I'm going to ask you is, what do you think? Do you think markets, if you look at, focusing on market prices, will it lead to, so for the moment, don't double think and say, what do I think about it? What do you think? Will focusing on market prices lead companies towards short-term decisions? Agree or disagree? No show of hands needed. Second, if managers make decisions without having to worry about the effect of stock prices, will they make better long-term decisions? That's a sales pitch here from managers, right? Or third, you can say, well, neither of these groups is particularly long-term. The question is, who's more long-term? So basically, the question I'm asking is, do you trust managers at the expense of markets, or do you mistrust them both? I'll tell you my priors. I don't trust either group. I don't think managers are particularly long-term. I think markets are. But I'm going to argue that the short-term basis for the argument that markets are short-term is built on some pretty thin growth. In fact, there is significant evidence that markets are far too long-term. Sounds like a weird thing to say, but let me back that up. If you look at the companies with the highest market prices out there, they're often companies, especially in the last decade, money-losing companies, no business model, and markets are attaching a $20 billion value. I know the investors hope to make money short-term, but they were attaching fact, the evidence is that companies with current earnings, stable, low growth companies are underpriced, not overpriced. Right? And when markets announce something that adds to future growth, markets are pretty, or companies announce something that's supposed to add to future growth, markets give them a lot of leeway. Depends on the company, of course. In fact, R&D announcements, if you look at R&D announcements and different kinds of announcements companies make, that cost managers investors' current earnings, but offer the future growth. For the most part, market reaction is positive when companies come out and say, I'm going to invest X billion dollars to get you growth in the future. The only grouping that doesn't seem to have much of a payoff is product strategies, but those are the emptiest of all announcements. There's no money there. You're saying my strategy will be different. I'm planning to do something different. You're saying, what about Facebook and the metaverse? You remember the story of Facebook. What did Facebook say they were going to invest? $100 billion in the metaverse. If you're a Facebook shareholder, what's your next question going to be? What the heck is the metaverse? And how are you going to make money on it? My vision of the metaverse, I can see it's virtual reality. I think SimCity 30 years ago. I mean, basically you can live in a virtual world. You can build a virtual house. You can get a virtual spouse. You can have virtual kids. You can send them off to virtual college. This sounds incredibly attractive to some people. I'm not, So I can understand it. But how exactly do you plan to make money? That was the question Facebook did not answer. And I think markets correctly punish them, saying, you want to invest $100 billion of my money, but you can't tell me whether you're making money in advertising, from transactions, from being the ecosystem in which you charge other people for being there. It was a singular lack of discipline in the pace of, and to give Facebook credit, they've learned. If you look at the last few earnings report, and part of the reason his stock price is up is Mark Zuckerberg said, you're right, I'm not going to throw $100 billion down a hole and not tell you what's in the hole. So not all long-term announcements get rewarded, but for the most part, markets are much more long-term than we give them credit for. So I'm going to stop with that. When we start off tomorrow, we'll start with, or on Wednesday, we'll do the last piece of this, corporate governance puzzle, and hopefully we'll get done with it. Okay. I send it to a class A. You won't get it if you're not in a class A. That comes from the user group that was created